So it's often considered 50% a month, which is
50% a month.
thousands and thousands of percent per year. Because you compound that for 12 months exponentially, you need extraordinarily high inflation. So for example, even the high inflation of Turkey and Argentina is not necessarily considered hyperinflation. Whereas, for example, obviously the Weimar Republic was a hyperinflation,
Hmm.
Zimbabwe was hyperinflation. I believe Venezuela it classified for long periods of time as hyperinflation. But above a certain point, it almost doesn't matter too much. I mean, obviously there's a difference between, say, 25% inflation in Turkey versus, say, 1,000,000% inflation in Venezuela. There's a difference there. But once you start getting into double digits, inflation becomes obviously a major issue in any market. And historically, hyperinflations tend to happen. There's kind of two big ingredients that go into making hyperinflations happen. So one is some sort of damage to your productive systems. So that can include, for example, in Zimbabwe, they reorganized how they do farming. There's, basically social conflict there. That's a very long story, but you had a production collapse, and of course Weimar Germany after World War One. I mean, they were impaired in terms of the damage they sustained from the war and the economic consequences of that. The other big kind of ingredient is when you have liabilities denominated in an asset that you can't print. So in developed markets, they have a lot of debt, but it's in their own currency, and so it's somewhat easier to kind of quote unquote taper Ponzi. You can kind of do that kind of over time. Whereas if you're an emerging market and if you say you owe dollars, right? There's no way that your country can create dollars other than earn them through trade, and so you can pretty easily run into default scenarios and currency collapses. Same thing for Weimar Republic. They owed war reparations that were denominated in gold, and so it contributed to their being unable to service those debts. And so generally in developed markets today, we don't directly see the kind of the ingredients of hyperinflation. But so my base case for a while, the kind of the call that I've been making for the past couple years is that I expect the 2020s to be a pretty inflationary decade. Now, hyperinflation has not been my base case in developed markets, but I don't rule it out as a possibility because after a certain point, if people lose confidence in the system, if they don't want to buy the bonds, and if you start to see kind of a out of control kind of deficit monetization, then anything is possible. And so, especially when you combine that with energy scarcity or deglobalization or potentially any sort of black swan event that could occur, like a natural disaster or even some well telegraphed events, like if China ever were to say invade Taiwan, then there's potential war between two nuclear powers. Who knows what could happen there? So there are catalysts that I think could get the world to a more hyperinflationary type of scenario. But it's my overall view has just been focusing on the inflation side more so than the question of hyperinflation.
Yeah, I mean, Jack's tweet you could say was slightly hyperbolic. I mean, other people would point and say, "No, it's correct. This will happen, or it might happen." But I would struggle to see the idea that the US would enter hyperinflation. But I think, like you said, you can focus on the actual inflation that's happening, or risks of inflation, and as you rightly noted, like Turkey and Argentina are both experiencing very high inflation at the moment, and that has dramatic effects. That has dramatic effects on the local economy and the people who live there. So even if we were to see 10, 15, 20% inflation in the US, the UK, that still would be a very bad scenario for a lot of people, especially if this was something to carry on for a decade.
Yeah, and so one of the big things that I focus on is the fact that because we're towards the end of this long-term debt cycle where they pretty much have to hold rates low despite inflation, because otherwise, the sovereign entities are insolvent. That opens like kind of the possibility of this spiraling out of control. And so, if you want to make the hyperinflationary argument, you basically would go back to history and say that no fiat currencies lasted particularly long. And so the structure that we've had in place since the 1970s, which is that the entire world is on a fiat currency standard, is very unique in human history, and it's only so far a 50-year experiment. And so especially this is the first time that the fiat currency system is tested with an inflationary environment, while we have this much debt in the system, and real interest rates are this low. So the last time we went through this was like the 40s in the developed world, the 20s, 30s, and 40s. And back then they had a gold peg, and so a lot of them had to break their gold peg, but then they reestablished their gold peg at a lower level, and eventually, of course, transitioned to the Bretton Woods system. And so they still had a tether to commodity-based money. Whereas now we're going through a similar phenomenon, but in a purely fiat currency regime. And so there are a lot of big questions about how they're going to navigate this. And one of my overall views is that basically I would position for hyperinflation similar to how I position for inflation anyway. And so my overall view is basically have hard, scarce assets, productive assets or good monetary goods. So some people, they prefer gold, some people prefer Bitcoin, some people prefer a mix of both. So those combinations of, say, commodity producers, hard assets, good real estate, and then good monies is the protection either way against a full range of kind of inflationary scenarios. Whereas if you get into extreme inflation or hyperinflation, then you also have to consider personal security, kind of prepping type of mindset. Basically have resources available so that as kind of society goes through very difficult periods, that you're positioned to kind of meet your basic needs for a decent period of time if you have to, if you have a pretty severe breakdown in supply chains and some of these other kind of shortages.
You said, I think it was one of your tweets, you said this is more like the 40s than the 70s. What did you mean by that?
So that goes back to the idea of the long-term debt cycle. So in the 70s, they had actually already inflated away a lot of the debt from the 40s and going into the 70s. And so in the 1970s, the issue was, there were a couple of issues. One is that the United States did not have enough gold to back the Bretton Woods system anymore. That had been building up for decades. It wasn't like, by the time 1971 came, they already messed up. There were already too many dollars outstanding compared to how much gold they had, and so the system was unsustainable. And so that system broke. In addition, energy production, oil and gas production in the United States peaked. And so the United States became more reliant on importing oil and gas. And of course, you had oil embargoes and political issues like that. And so basically that combination of devaluing the currency, defaulting on the gold standard, devaluing the currency, combined with real resource constraints, basically lack of energy, created a very fertile ground for inflation. And the only saving grace was that debt as a percentage of GDP was very, very low throughout the developed world.